my pleasure to present to you a special edition of the Hot Seat this afternoon with my friends and fellow recovering members of the NAFC Merger and Acquisition Task Force. I'm Spencer Tenney, CEO of the Tenney Group, M&A advisory firm that's been dedicated to the transportation logistics space since 1973. I want to pass it over to our moderator for this panel and good friend Dan Cook, True North Insurance Companies. Dan.
Thank you, Spencer. I appreciate the opportunity to be back on the hot seat and spend some time talking to you and Michael and Heidi, three very experienced merger and acquisition professionals, and picking your brain on things that your audience probably needs to know and is curious about. I think probably beneficial for the audience is a little understanding of who we are and why we're here today talking on this topic. I think I'm in my 32nd year of this business. I head up what we call the national primary practice at True North, really focused on the transportation and logistics space. Within that is our captive feasibility and captive diligence practice, and also the M&A diligence support group. And through that, I get to work with Michael and Heidi and Spencer throughout the year on a variety of projects. And Heidi, I think maybe I start with you. If you don't mind a little self-introduction, we'd appreciate that.
Sure, that's happy to do that. So my name is Heidi Horning-Scher. I'm an attorney at Scudder Law Firm. We are a business law boutique that has a primary focus on transportation and logistics. I've had the opportunity to work with the other panelists today on M&A and as it affects the industry through the NAFC M&A Task Force, and also on transactions as well. But as I said, we just specialize in business transactions, and a lot of those are mergers and acquisitions in this industry.
Thanks, Heidi. And Michael, very much the same, supporting the industry's transactions. A little your more varied background.
That sounds great. Appreciate it. Michael Fennerty, I'm with KSM. We're the largest CPA firm and advisory firm based out of Indianapolis. We've got some other satellite offices kind of throughout the U.S. However, headquarters are here based out of Indianapolis. I'm a director in our transaction advisory services group. So we specialize in both buy side and sell side financial due diligence, tax due diligence, tax structuring, quality of earnings assessments. Transportation and logistics is one of our largest kind of industry groups, both across our firm and within our transaction advisory services group. So appreciate you guys kind of allowing me to be a member on the hot seat here for the first time, and kind of looking forward to the discussions we'll have kind of around current M&A trends and so forth.
And Spencer, while I think you need little introduction to this audience, inevitably there'll be a new people and new audiences that get to hear this recording. And so if you don't mind, take a little time and give us your background as well.
Right. So my family's been in transportation for 3 generations. My dad started advising on business sales and acquisitions exclusively in this space back in 1973. And that's effectively what we've dedicated our business to over that time period. And most of what we do is sell-side representation, helping folks that have built a wonderful transportation logistics business prepare and execute and exit. And most of those companies are somewhere between that 20 to 300 million in annual revenue, top line revenue size. So pleased to be with you and excited to open up this discussion to talk about what is going on in M&A mid-year 2023. This is going to be fun.
Hey, and that's a great segue, and I'm going to make you start that process. Why don't from your seat, because I know you look at a great deal of transactions and support many families that are considering a potential equity event. Tell us what you've seen in the first half of the year, what's happened with valuations, a little bit about what's happened with terms. I think this is a question, honestly, that I'd like to float out to each of the panelists. So if you take first bite at it, Spencer.
Yeah, I'll definitely. I mean, I think that this could be, we could probably do a whole episode just on that one question, but some general insights that we've observed is tremendous impact on transaction that are asset light, that are particularly large. I think there's been that we've observed significant hesitation on engagement and valuation questions about large asset-light deals. Where we've seen less effects are on your smaller or mid-size asset-heavy transactions. And certainly the deals are getting done, but where we're seeing the most effect is how they are structured and in some cases the valuation on those. It's been just look at the amount of effects to interest rate hikes over the last 12 months. Unquestionably, they've impacted the way that both buyers and sellers are approaching deals. But I think that what I would say, probably despite some of the headlines that you would see across our industry, our firm has remained extremely active, closing 3 deals in the next 45 days. So the deals are still getting done. I think the key takeaway that I would say is that the way that they're getting done is quite a bit different than maybe what we saw 12 or even 6 months ago.
Well, maybe I'll split that then, into valuations and the ways deals are getting done. Michael, why don't we start with you? What do you see in the way of valuations in the first 6 months of the year, maybe in comparison to what we saw in 22?
I would kind of echo some of what Spencer just mentioned. We were very busy as a firm the first part of this year, the first half of this year, almost to today. I think Q1 was our busiest quarter that we've ever had as a firm in the M&A space. We are seeing more sell side work than buy side, however, which we kind of expected in today's market. But we are still seeing deals get done. We actually just put an article out there that we've seen a little bit of a valuation gap between buyers and sellers here recently. Sellers are still expecting valuations from 2021, 2022, and buyers are, having to do deals with higher interest rates. There's still a lot of uncertainty around inflation. So we're seeing deals get done in a way in which risk is being shifted to the sellers. There's also been limited access to debt. So looking at alternative financing solutions as well, ways that things are maybe risk is getting shifted to the sellers a little bit is having to do some earnouts. That earnouts can complicate things, some seller notes. Those types of things we are seeing as more common kind of as we get further along here in 2023.
Yeah, to that value gap, Heidi, because I think that is real between what sellers want to pay right now and what buyers believe they'd like to have. How are you seeing deals be structured to help bridge that gap?
Yeah, so I think there is, as Michael mentioned, just a lot more in earnout, deferred payment, seller note, also seller rolling equity we're seeing more often. And then also that's like the structure after the deal, but also before you get to a closing, people are just a lot more sensitive in their diligence given their, things are tighter. The credit market's tighter. The freight market, obviously is not good, and especially for the brokerage companies. So we've seen a lot more focus on diligence and reviewing customer contracts. The reps will go deeper into the customer list. The diligence will go deeper. Buyers wanting to know more about the customers. Also, the lenders are a lot more focused on the deal. I think generally they're doing fewer deals and they have more time to focus on it, but they're very focused on the financial covenants. I would say when people are modeling out their financial covenants, both lenders and buyers, things are a little bit tighter than we normally see in the covenants. And so, as everyone said, deals are getting done, but there's just a lot more focus on how can we get it done and really kind of reduce the risk because of how we've structured the deal, how we've diligenced the deal, and how we finance the deal.
Well, kind of on that same frame, Michael, for you, most buyers operate off of TTM, and some of the healthier months are starting to drop off as this freight recession, depression, whatever you want to call it, prolongs, what do you see in that due to values?
We are seeing I think we have seen values come down slightly, just with interest rates rising. The return on investment for buyers, the interest rates are eating at that return. So, performance, also with performance kind of creeping down, and prior months kind of falling off of trailing 12 performance figures, we are seeing some valuations kind of trend downwards as well. So, with quality assets, buyers still want to try to get deals done. So I think they're thinking forward rather than just looking at the trailing 12. They're having to get more creative, as we've mentioned, around structure. But for quality assets, deals are still getting done, and both buyers and sellers are having to look at a number of different things rather than just trailing 12-month EBITDA in order to kind of get these done.
Well, so Spencer, a perfect segue over to you, as Tenney kind of being the preeminent sales side advisor in the transportation industry. You're having to speak to the sellers relative to this value gap or perceived gap. How's your firm addressing that with potential sellers? And what are some of the advice you're giving business owners to try to build and present value in this marketplace?
Well, I think there's two camps. One is when you're already involved in a deal and you're in this freight market and you're having these, month over month changes in the TTM performance in the way that everybody that's looking at the business, how they respond to that. So I think that's a real issue about kind of navigating how do you get a deal done when that's happening in real time. I think the good news is that they're still getting done. Just again, we have to be creative in how we kind of bracket some of these risks for everybody that's involved in that transaction. Now, for the people that are, what we're observing is this. There's a lot of business owners that just demographically had intended to exit pre-COVID, and then COVID came and either, they just didn't have time to think about an exit because all they could do was just be in the moment. There were some people that had intended to exit, but then they had the year or 2 years of a lifetime and just needed to ride that wave. And I think what we're seeing is just kind of a natural progression of they're just tired. There's just folks that have got to the point where they're exhausted after 36 months of 3 very different experiences year over year. And I think there's just folks that realize that we had a great period from a performance standpoint. We experienced the benefit of that. But when they look at moving ahead, okay, am I going to be able to lean in and reinvest for the next 3 to 5 years until we get another cycle like we just have? I don't think that's ever going to happen. But I think there's just a certain level of levity with a lot of sellers that just understand that I'm probably not going to reinvest and double down on certain things that I don't feel like are going to benefit me. So they're going to go to the table and they're going to use structure to help give them the benefit to participate in the upside of future performance as part of kind of hedging and getting a deal done. And what's interesting about that, I think that we're also seeing a lot of new buyers enter this space right now, which is helpful from a supply and demand standpoint for sellers. There's a lot of buyers that are now engaging and looking at smaller to mid-sized deals that thought that the markets of the last 24 months were too frothy and stayed on the sidelines. Well, now we're still getting demand and we're getting competition for sellers because, quite frankly, for those that intend to be in this market and have a profitable and resilient business, if all of your major expense line items continue to rise and the freight market is soft, you're going to need something to offset those losses. And so acquisitions continues to be more attractive than just eating those losses. And so I think there's signs of encouragement for sellers. And I think the educated seller, when weighing the cost of reinvesting and trying to advance their sell, some might say, if I was, 15 years younger, maybe I do that. I think the reality is some folks just are in a season of life where that's not really an option. So they're trying to use whatever leverage they can to maximize their opportunities in the market right now.
We've seen over the years, we've all seen over the years that there's a bit of a market cycle impact relative to interest rates, where at times, such as in the low interest rate environment that we were in, private equity has a really strong buying position, and they're very, very active in the marketplace. And when interest rates start to rise to the levels that they're at today, it feels to me that it brings back in strategics in a more meaningful way. And so I don't know if it's new buyers or it's just the buying cycles change, and now the leading buyers are operating companies more so than the private equity. Heidi, are you witnessing that in transactions that you're doing?
I am. I do think that we have seen deals that have been in the market where we have private equity interest, but I think I see the strategic buyers winning out more often. And I just think part of that is driven by the credit markets and, some of the restrictions that people are in funding deals where a strategic may have cash on the balance sheet or financing arrangement in place. But yes, I'm seeing that, and we are, there are deals of all sizes still getting done with strategics. We've worked on the Knight Swift acquisition of U.S. Express, the Covenant Logistics acquisition of Lou Thomas, a number of other deals where, you see strategics doing deals. I do think when the freight market is tight, I think that strategics generally have a better appetite for understanding what's happening and why it's happening. Now, I also think, however, that strategics have become more focused on what they want. So, for instance, I think just a generic regional truckload carrier operating at a 95 is going to have a very difficult time finding a deal. But if you're a company that's operating more profitably and perhaps are in an area where they want to focus, there's been a lot of growth in Savannah, for example, with the port there. There's been a lot of changes in the supply chain since COVID that people are focusing not just on what that company does, but where is it based? Where are the, supply chain, focus? Where's the population growing? And so I just think that strategics kind of have a better understanding of, where the freight market is, where the shippers have needs that may line up with the carrier. And then also on the brokerage side, is it a specialty broker? Does it focus in on refrigerated or flatbed or have some other niche that they can really see it coming out the other side and being very profitable? So I would agree with you, Dan, that obviously you cast a wide net if you're on the sell side, and Spencer's team does a great job of that. But as far as things getting done, maybe a slight trend where you see strategics more often, like you identified.
Yeah, it makes me think of Michael's counterparts over at KSM Advisory, David and Chris, talking about freight optimization. Spencer, are you seeing in deals that a number of the strategics are looking at your companies that you're bringing to market just to optimize lanes as a reason to do deals today?
I think what we're seeing as a general characteristic is just kind of alluded to what Heidi was talking about, just much more engagement and sophistication about how to really be accretive with this, whatever this acquisition is going to be. And obviously technology is helping, but just in a conversation with a very large strategic global player, and just kind of comparing notes on where they see from a network analysis, where are they strong and where are they not, and then using that data to help create profiles for their future growth strategy. And I think that, to your point, David and Chris, we've talked about that at length, and it's a tremendous resource in what they're providing. We're seeing a trend where just that, especially when the freight market's soft, the margin for error is almost zero. So you have to go attack the type of deals and the targets that are going to be the most additive from a value creation standpoint. And I also think that's really exciting. I think when you start seeing buyers being very disciplined, it's good for the industry too.
Michael, I want to pick your brain because I know why you spend a great deal of time in the transportation space. You oversee also a broader practice in the transaction space. So are there trends, are there lessons learned, are there things outside of the transportation industry that might eventually be commonplace or useful in transactions here?
I think a lot of it is kind of transpires to other industries too. Um, some industries that we're still seeing like perform really well are like manufacturing and distribution companies, industrial type businesses that are still performing really well and still getting really good multiples and driving good valuations. There's other industries that we've seen where performance is down and it's harder to get some deals done in those industries. Um, like tech and consumer based industries have taken a hit from what we've seen over the last 6 to 8 months, due to inflationary pressures and things like that. But we're still seeing deals get done amongst a wide array of industries. I would agree that strategics seem to be uh, winning more of the deals that we've been involved in as well. I think they don't have a shorter investment time period that they're focused on. They can think longer term, and they can kind of ride out some of these uncertain times, have the appetite to ride these uncertain times out, more so than some of the financial sponsors. So I think we're seeing a lot of similar trends within other industries as well, but certainly seeing specific industries kind of with less with performance trending down, and fewer deals getting done in those industries.
I love the added diligence that's being done. I think a really healthy diligence process is good for both the seller and the buyer, particularly when the sellers retain some level of skin in the game post transaction. Hey, Heidi, I wonder from the legal standpoint, are there legal areas that in this environment you're seeing heightened sensitivity to or scrutiny of as you transact deals?
Yeah, for sure. Obviously I mentioned the customers earlier. Increased focus on that. The independent contractor classification will continue to be an issue. Um, One of the things we've seen is buyers relying more heavily or more often getting in specialists to help with diligence. And so I'm sure, Dan and True North, that's what they assist with. And so, for instance, if you have an insurance issue and buyers more often, having a resource come in and look at that, or Michael's team on, financial review, tax review, and such. And so I think that people are understanding that, they want to make sure that if they're going to do the deal, there are no issues. I also think that has arisen a little bit because of the representation and warranty insurance market. That's been a great thing for buyers and sellers as that's grown over the last couple of years. It retracted a little bit with the deal size getting bigger, and then it's come back down. But when you have representation and warranty insurance in a transaction, there will be a number of specialists that the carrier will be engaging to make sure everything is right. And I think buyers are saying, hey, that's a good value, to have someone come in and look at making sure everything's okay. Obviously, it helps you get a broader scope of coverage. And so, that's a trend I've seen. I don't know if it will go the other way once the deal volume picks up and the interest picks up and the credit markets maybe make it a little easier for private equity to be involved, but definitely a trend. And I don't know, turning it back on you, Dan, I mean, you guys help a lot in acquisitions and people have insurance issues, either both in diligence and also the transition. Are you seeing, more interest in that when, for people to bring in a third party like True North when they are doing an acquisition?
Yeah, we have more demand than we've ever had. And I also see we represent a lot of the very large strategics, and I see them involving us much earlier in the process. we often know during target selection or target identification, and are asked to do some light diligence work pre LOI in some instances. The other thing is they're asking for more services. We've had to build stronger cyber capabilities. So we either bring in third-party cyber specialists or we deploy our internal team as part of the diligence process. That's an area that, honestly, 7, 8, 9 years ago, we didn't put much energy around. To your point on reps and warranties, in a former life at an international broker, I was involved in those early programs 20 years ago. And it was really expensive, and the deductibles were really large, and you have to have a really large transaction to have that make sense. None of that's true anymore, right? I mean, you've got low minimum premiums, and they become much more commonplace. What has changed for me in the last 5 years, though, is the number of reps and warranties projects that actually turn into the buyer and seller purchasing the insurance. It used to be they would pay the fee and we would get quotes for the coverage, and it was a way to resolve remaining open items, and they would solve it between themselves and they wouldn't purchase the insurance, which is fine. But today they're actually procuring the insurance as part of the transaction. Spencer, are you seeing that same thing?
We are. I think that there's just a growing comfort as the normalization of this just being an instrument that can streamline kind of like these final processes of getting alignment and mitigating risk. And so I think that definitely see a trend towards normalizing this. And like you said, getting the coverage as a way to just expedite certain things in a way that's fair, that mitigates risk and simplifies things for both buyer and seller. When it's very important to simplify something at the end of the deal.
Yeah. So let's talk about brokerage margins, the spot market, and just general freight prices. In the context of historically using trailing 12 months and now using something perhaps different or some combination to get to value. And I guess I'd ask each of you, what are you, and maybe I'll ask Michael first, are you seeing buyers still rely on trailing 12 to establish future projections, or is there some other model that you're seeing in deals?
We are seeing buyers kind of use a further look back period to try to get comfortable with what the trends could be over several years, and not necessarily focusing on the trailing 12 to set the valuation. Maybe it's looking at an average of the last couple of years in conjunction with what they're projecting for the next year or two to kind of set the valuation. For motivated buyers, we're seeing them kind of focus outside of just the trailing 12 in order to kind of make sense of the valuation and to get the deals done.
Spencer, do sellers understand that?
I think that today we have a much more educated and humble seller than we maybe had like 12 months ago. I think that you can't be removed from the realities of just the natural risk within the market. So what we're observing very much so is that there is an expectation that for sellers coming to the market to share more risk than they would have 12 months ago, and to be more realistic about the valuation approach, typically being spread across multiple different periods, so that the buyer has some protection about what that, and it's more than likely going to be a combination of past, present, and future of what and incorporating some type of earnout in there. And then the blend of that, it's a sure way that buyer and seller can get aligned on both value and risk sharing.
Yeah, because at the end of the day, right, where the seller is trying to get the maximum value for the equity event, but also in many cases a fair value, and buyers are willing to pay a fair value. And in this uncertain freight market, it's hard to know what that is. Heidi, any other comments around the way that buyers are addressing this?
No, I think that the it's really hard in the brokerage market, I think, to value anything on future earnings. It's just hard to do. Perhaps if you have more long-term contracts, but we've closed a couple brokerage deals in the last couple months, and so they're still getting done. But it's pretty hard, and you just got to actually, for sellers, you just got to be a little bit patient too. We've had deals that have taken months to get done, or months more than they normally would. Deals that have been on and off with the same buyer and seller and finally get done. Obviously, very important to just keep running your business and producing results, and kind of proving yourself out. And if you're want to get it sold, you may need a little bit of patience, and obviously proving it out with performance as the transaction is progressing.
Chairman of our company has a saying: we want to run this business like it's for sale, and then we'll never have to. And I think that's good advice for many of the motor carriers in this volatile market we're in today. I think, and with that, it kind of brings me to a final question. We've been talking about really the first half of 2023, and we've been looking back at prior periods and comparing, if you will. And many people that are probably listening in or watching the session are wondering, okay, but what about the second half of 23 and maybe even early 24? What can I look forward to? I think, Michael, I'll start with you and just tell us exactly what's going to happen with transactions in the second half of 23.
Let me pull out my crystal ball. But no, I think kind of the general sentiment that we're hearing, talking to private equity players, bankers, etc. I think what we've seen is steady deal flow, but I think the general sentiment is we kind of expect deal flow to pick up here in the second half of 23. So we expect kind of a robust M&A activity as we kind of get into the second half of 23, early 2024. I think we've seen some good recent inflationary indicators. Hopefully that will kind of help keep deal volume afloat. But we're pretty bullish on the second half of 23. We've remained busy as a firm. I've seen a lot of deals kind of in our space, lower middle market activity. So we do expect things to pick up even more kind of second half of 2023.
I think I'll ask Spencer to put a bow on it, but Heidi first before I do that. What are your thoughts?
I agree with Michael, and given the number of deals they have with their presence in the space, it means a lot. But I think it's the freight market is everyone thought it maybe be turned by the end of the year, and I think maybe it's going to be early 2024, which I think that drives deals a lot. But we have deals that are just in the starting phase at a rate that I think is kind of what I would expect for continuation of what we saw in the first. I think deals will continue to get done. I don't see that there's going to be a huge jump in deal volume, but I think companies that are trying to sell that have something special to offer, I think those deals can get done.
Okay, and Spencer, I think if you'd put a bow on maybe this question, what you see in 2023, maybe any nuggets you want to share with potential sellers, what they should be thinking about in the end of the year or early next year, and maybe wrap this up for us. Appreciate it.
Yeah, what we're seeing is that there has been kind of a wait and see for a lot of folks who have desired to exit, and I think what we're going to see in the second half is the activation of a lot of folks that begin their exit strategy that have kind of been on the sidelines for a little while. So I think we're going to see an increased supply of available companies to purchase, primarily in what makes up the majority of the industry, that smaller and mid-sized transaction, which can get done. And I think it's a function of supply and demand. I think that by the end of this year, there will be very strong supply of companies available for purchase. It's been a little bit lighter, especially in Q2 so far. But once that happens, I think it's going to be important for those that really have specific timelines around their desires to exit, that they're going to want to be in the front end of that conversation. Because if the market becomes oversupplied with kind of like with that profile that Heidi was sharing with us, where there's not really that much differentiation, they're going to suffer from a valuation standpoint. So it's really going to be important for them to be assessed when there's not an oversupply of companies available to purchase as part of protecting business value and what they experience in their ultimate exit.
That sounds good. Well, I want to thank all of you for your time and sharing your wisdom today. Very much want to thank the Tenney Group for allowing this panel to participate in this session of the Hot Seat. I always look forward to getting the announcements when there's another Hot Seat session coming out to listen into. So very much appreciate all of you and hope the audience takes something away from today's session.